I think in the longer run, we're going to have conversations about moving forward on those types of things. For me, I was very supportive of moving forward with initiatives in this area. This was one area where outside of the Dodd-Frank rulemaking, there was actually bipartisan support, and we had a lane to run in to get this stuff done for a couple of reasons. One, it's stuff we should have been doing all along anyway, and second, for me, it was a way for us to push back against the prudential regulators, the banking regulators, either individually or through organizations like the FSOC or international organizations called the FSB that were trying to exert their authority in our regulatory space, right? It was a little bit of sort of defending our turf and pushing back, but in fairness, they did identify some gaps and weaknesses in some of the data that we got, and so that, as you pointed out, the Form ADV on the investment advisor side, the investment company side, we're getting better data about portfolio holdings and those types of things. And then, potentially the use of derivatives and transition planning and all those sorts of things. I think they're all good things to move forward on. I think it's going to be a longer-term issue with Commissioner Stein and I. On the derivatives rulemaking, I preferred more of an incremental approach rather than what was proposed. I dissented from the proposal. In fact, the data gathering piece that we did, one of the reasons that motivated that, we said in the release, was to start getting better information about the use of derivatives to inform future rulemaking. I'd prefer to actually get that data in, analyze it, and let it inform future rulemaking rather than move forward with a big rule in that space. In transition plans, what was proposed was coming up with a new thing. I think it was Section 206 or something, a new anti-fraud rule. I mean, I think 20647 sort of it could fit within there, whether we call it that or not. I mean, it's continuity planning, transition planning. I think
right. That was our comment on.
Yeah, exactly. Right. I knew that. So no, I mean, it's kind of some of it is a little bit of we need to show that we're sort of filling the space in order to get these the prudential regulators off our back. That's less of a concern now with the changeover in the administration and sort of changes that are going on at the international level as well too. But if there's something that's sort of good government stuff that we can get done, I think that makes sense. You also mentioned stress testing. That is a requirement under Dodd-Frank. It's really, really difficult for us to figure out how stress testing applies to, say, a mutual fund, right? It's like, what happens when the securities, the asset values go down? Well, the NAV goes down, right? It's not like a bank where you're going to go and run into some sort of insolvency issues or whatever. And so we've been trying, it's a different sort of animal and trying to think about that. It was unfortunate, it gets kind of thrown into Dodd-Frank along with sort of, the banks and bank holding companies and stuff, but we'll sort of have to figure that one out. That's a longer term, those are longer term issues I think we're going to take a look at. I think there may be an opportunity now to sort of review some of the things we're seeing in the liquidity risk management. Some people are saying there's maybe some unintended consequences there that we'll have to take a look at, but I think that's where we're going to go on that.